Hi, this is Dr. Stacy Lau. This is talking about the GIS and land for regulatory. A lot of the regulatory agencies have their own GIS, as I have here on the screen. Here's Wyoming, and we have Ohio's, Texas. We do a lot in there just for this course, but you'll find pretty much the same information. There are some land records in these databases, and if you click on some of the wells, you might be able to say go in and look through the different wells. That one's a dry hole. We'll look at the next one and see if we could look at all the records that they have on that location. So here I came in and I see that there's three different sets of informations that are there, and you might need to click on each one of these, and then it's going to take you to the other database where you have several documents that might be attached, either communications from the regulatory, applications for permits to drill, maybe some wellhead pressure information. You'll sometimes see log files, the casing information. You'll have some information where they've maybe gone in and done some workover information, or shut-in information might be attached to the file folder about this. But as you look through each one of these documents, you will sometimes stumble on something like this. And here I have a drawing of a well permit with a plat, and it has some key land information. Not a lot in that one right there, but if you looked at other ones, you might find other sets of information. Here's an older one I found that was done on another area, and I've got some ties, and it shows a little bit more detail. And I think you will see, you will go through and you'll find other things. So it might have even what to find at those corners and different things, so that if you had to reproduce these boundary systems, those records could be helpful in building your land record database. But in general, a lot of times in the land record database, like the one in Colorado, for example, they don't necessarily, the one in Ohio, they don't have the land records. They might have copies of the plats or permits for things that were submitted and any of those documents, and you can go in and link to those as well. Key things to look at is, well, maybe I want to have my own GIS and don't want to go to their GIS. And I look at, when I click on this location right there, and I get this search information, that URL right there could be duplicated and added to your GIS, so that when you click inside your GIS, you would get this same kind of pop-up. Or even if you look at this PDF that we have here. Here I have a PDF of information that's there. If I had a view of that PDF and I wanted to look at that document itself, that URL or that download, if I wanted to download this document, this is a URL command that you actually could use FME to write that for us, so that you could then use it. You can see here there's some wildcard information in here that's there, but there are some things that you can look at where that actual PDF is. Just append that API number and it will link that inside your database, and we'll look at some of that later on. But for the most part, the land record information that's inside here from the regulatory information is not intended to help you to maintain your well information, your land record information at the individual operators level, or even for the royalty owners. A lot of the public will go in here and try to look at their land, their information, and not be able to find it, right? So it's not necessarily intended to be there, but you can find, things such as in the permits, a lot of the permit plats that were done and submitted, and those the public can download and look at, and they are useful. And if you click on something like this, you can see the URL down here below. Again, that's easy for us to reproduce and actually make a field in our GIS that would also link to that plat. All I need to do is basically take this URL that's there, write an FME job that says for every one of my wells, go and grab that plat, so I can quickly pull that plat in and look at it from that standpoint. There's also some work that I'm doing in terms of taking those plats that you see that come up and actually georeferencing them so that they land on top of where I want to see them and be able to look at them. Okay, so if you go on and look in some of these different databases and think about what they do for you regulatory wise, a lot of great information in the regulatory databases. You could either go and download these databases, purchase links through other vendors, or write your own to try to get some of that data into your database. Later I'll show some if they have the capability to have REST services where you can connect those to your existing GIS, or at least write FMEs to be able to link to some of the information in those databases. All right, good luck.
Introduction. Federal mineral royalty revenues are often overlooked, but they represent a substantial portion of some states' revenues. Certain minerals, such as coal, oil, and gas, are available for extraction and production via contractual agreement between a private producer and the federal government known as a mineral lease. These leases grant rights to firms for a certain period of time and outline payments to be made by producers to the federal government. Some of these payment revenues are then distributed back to the state in which the mineral production took place. One of these payments is a royalty, which is calculated based on the amount of mineral production on the leased land. The term royalty is a historical artifact. It literally means a payment to the crown. Today, the royalties are payments to a landowner, in this case, the federal government, for the right to extract minerals from the land. Payments are calculated as a percentage of revenue. In fiscal year 2012, 36 states received federal mineral royalty disbursements totaling $2.1 billion. In March, the Office of Natural Resources Revenue announced that, due to sequestration, $110 million in royalty revenue payments to states would be withheld. Some state officials contend that royalty payments are the legal property of the states and have explored legal recourse to the federal government's actions. The Department of the Interior, however, asserts that they are not exempt from sequestration. Historical development of mineral production in the United States. In the latter portion of the 18th century, many existing states had claims to lands in the West. The Land Ordinance of 1785 and the Northwest Ordinances of 1785 and 1787 ceded the western land claims of the early eastern states to the federal government, allowing the land to be sold. This enabled westward expansion, federal revenue generation, and paved the way for the creation of future states. 7. By 1821, 7 states had emerged from public lands in the West, with ownership of portions of the land within their borders retained by the federal government. The push for development continued into the 19th century by means of the General Mining Law of 1872, under which the federal government granted permanent and exclusive mining rights with no royalty obligations. As time went on, some called for stronger oversight of the extraction process and questioned whether extraction was the best land use. Further, critics questioned why firms were not required to forego a portion of profits to the owner of the land, the federal government. These concerns led to the enactment of the Mineral Leasing Act of 1920, authorizing the Department of the Interior to lease federal lands for the production of oil and gas and other hard minerals. It limited the lands on which mineral production could occur and required royalty payments to be made by the leaseholder. Federally owned public lands across the U.S. Today, the federal government owns approximately 28% of land within the United States. The total land area within each state owned by the U.S. government. Nevada has the largest portion of total area owned by the federal government, 81.1%, followed by Utah, 66.5%, Alaska, 61.8%, Idaho, 61.7%, and Oregon, 53.0%. Mineral royalties collected by the federal government are dispersed to a variety of funds. 50% of onshore lease revenue goes to the state in which the lease is located, except in the case of Alaska, where 90% of the royalties go back to the state. 40% is dispersed to the National Reclamation Fund. 16, except in the case of Alaska, where no reclamation fund disbursement takes place, and the remaining 10% goes to the U.S. Treasury. In the case of offshore leases, 27% of all payments go to the state in which lease is located. $150 million is deposited to the Historic Preservation Fund each year, and the remaining money goes to the U.S. Treasury. The U.S. Treasury derives the most benefit, keeping nearly 55% of total royalty revenues. State governments receive 17.5% of total payments. If a mineral owner has questions about an existing lease or royalty agreement, you may find the information you seek in the courthouse of the county where the land is located. Usually a call to the courthouse can help you determine if any of the documents on file. The Texas Railroad Commission maintains records regarding the reported production and disposition for all oil and gas produced from wells in the state. This information may be helpful in determining your interests. Additionally, the Commission also maintains records regarding the permitting of wells. You can search the Commission's online drilling permit database if you do not know the drilling permit number. Drilling permit records include plats and other documents designating the acreage in a pooled unit. But it is the mineral owner's responsibility to follow up, track, and confirm payments from lease or royalty agreements. The producers will typically pay the required oil production taxes. The state of Texas comptroller oversees the payment of oil production taxes. Producers, first purchasers and subsequent purchasers all must file certain reports with the comptroller. These reports outline in detail the amount of oil and gas produced monthly, counties and leases where the oil was produced, the price received or paid for the oil, and other information. For the state of Texas, mineral owners can find information on the statutes outlining the rights of royalty owners in the state statutes and Railroad Commission's rules. The statutes outlining the rights of royalty owners can be found in the Texas Natural Resources Code, Tex. Nat. Res. Code ANN. Sections 91.401 to 91.406 of the Natural Resources Code concern the timely payment of royalties. Note that 91.406 provides for minimum damages and recovery of attorney's fees in a successful action to recover past due payments. Section 91.501 to 91.506 of the Natural Resources Code outline the information to which royalty owners are entitled from their payer. The Railroad Commission cannot intervene in royalty matters. If mineral owners would like the names of experienced oil and gas attorneys in your area, the State Bar of Texas has a lawyer referral service and can provide a list of lawyers board certified in oil and gas law. Other states have similar statutes and rules found the governing bodies of minerals in those states. The Railroad Commission cannot advise mineral owner or royalty owner whether they should enter into a lease or any other agreement, or whether an operator is in compliance with the terms of a lease. Since these are private contractual matters, you may want to consider contacting an experienced oil and gas attorney. If the mineral owner has a working interest, or they participate in the cost to drill the well, they have some responsibilities for royalty payments. As a working interest owner in a well or property, mineral owners have the responsibility to pay or cause to be paid any royalties due under the lease agreement from which they derived their working interest. This is true even if they are not the operator of the well or property. They can cause the royalty to be paid by entering into an agreement with the operator or purchaser of production to pay the royalties on their behalf. The purpose of statutes are to provide basic royalty payment information to help those pay royalties timely. Remember, it is through the cooperation of the mineral owner and the working interest owners that oil and gas is produced. In Texas, the Texas Natural Resources Code Section 91 Subchapter J and L outline the following requirements. 1. When to pay royalties, when royalties can be suspended, and what interest rate to pay when interest is due. 2. What should be reported with a payment. 3. The statutory components of a division order. 4. What kind of notice to provide royalty owners when they buy a working interest or when the payer changes. 5. What information a royalty interest owner can request. In the state of Texas, if a mineral owner has questions about unclaimed royalties or other oil and gas proceeds, they could contact the Texas Comptroller of Public Accounts. The Texas Comptroller operates and maintains the Unclaimed Property Fund, and they have listings of unclaimed property by owner name. A person who tells a potential claimant about property that is reportable to the comptroller or that is in the possession of the comptroller may not charge a finder's fee which exceeds 10% of the value of the property. If the property is mineral proceeds, the fee may not include a portion of the underlying minerals or any production payment, overriding royalty, or similar payment. Tex. Prop. Code N. 74.507. Please note that as of September 1, 1996, the duties of the state treasurer were transferred to the Comptroller of Public Accounts. In Texas, the initial payment of royalties are paid 120 days after end of month of first sale. Ongoing payments are paid 1. 60 days after end of calendar month in which oil production sold to. 90 days after end of calendar month in which gas production sold. Payments must be paid when the payment reaches $100, or 2. If payments do not reach $100 within 12 months and are greater than $10, the aggregated amount must be paid. 3. Amounts that do not aggregate to $10 must be paid upon the sale or plugging of the property or at the owner's request. 4. If an owner requests payment more frequently, only aggregate to $25. Operators must report royalty payments with the following information: 1. Property identification, name, number, or both, and county and state. 2. Sales month and year. 3. Volume sold. 4. Price per barrel or MCF. 5. Severance or other taxes deducted. 6. Windfall profit taxes, repealed 1989. 7. Other deductions or adjustments. 8. Net value. 9. Owner decimal interest. 10. Owner gross value. 11. Owner net value. 12. Address and phone number where additional information can be obtained. In Texas, to maintain the payment of royalties, division orders are required. A division order is an instrument which sets forth the proportional ownership in produced hydrocarbons, including crude oil, natural gas, and NGLs. Sometimes the division order is referred to as a division of interest. More often than not, a single well or lease will have multiple owners. As a condition for the payment of proceeds, a payer may require a signed division order from the payee containing certain provisions. These provisions include: 1. Effective date of division order. 2. Property description and type of production. 3. Payee's fractional and/or decimal interest. 4. Payee's type of interest, royalty, override, etc. 5. Certification of title to the share of production being claimed. 6. Unless otherwise agreed to by the parties, agreement to notify payer at least 1 month in advance of effective date of any change of interest. 7. Agreement to indemnify and reimburse the payer for payments resulting from failure of title. 8. Authorization to suspend payment to payee for title dispute or adverse claim. 9. Name, address, and taxpayer identification number of payee. 10. Provisions for valuation and timing of settlements of oil and gas production to the payee. 11. Notification to the payee that other statutory rights may be available to a payee with regard to payments.